Okay, we're going to go ahead and get started. Hopefully everybody can hear me. If not, let me know by typing into the questions box. Today we're going to talk about the difference between futures options and stock options. Most people just assume that an option is an option, but not all options are created equally. There is a big difference, and we're going to talk about those today. For those of you that do not know who I am, my name is Carly Garner. I am a commodity broker, a futures and options broker at DeCarly Trading. If you haven't already, please visit our website, decarlytrading.com. There's a lot of free educational material, videos, articles. You can sign up for free newsletters, all those sorts of things. If you are on social media, check us out on Facebook, Twitter, and Instagram. You can just do a search for either DeCarly Trading, or if you type in @CarlyGarner on Twitter, that's my handle, you'll find us there. Along with being a broker, I'm also a market analyst or strategist, whatever you want to call it. I write a couple of newsletters for our brokerage clients, the Financial Futures Report and the DeCarly Perspective. They include market commentary, my best guess as to what might happen in the future, and also trading recommendations. I'm also a columnist for Stocks and Commodities magazine. And I've written 4 books on trading commodities. The newest is called Higher Probability Commodity Trading. It is available at any major book outlet, but it's probably most convenient and cheapest at Amazon. If you're not familiar with any of my other works, Higher Probability Commodity Trading is meant to be kind of the end-all be-all of everything commodity trading. It covers a lot of beginning topics and then jumps right into some of the advanced ideas. So I hope you like it. If you want some more information on the book, you can check it out at higherprobabilitycommoditytradingbook.com. All right, so before we talk about stock options versus commodity options, just want to make sure that you understand that there is a substantial risk of loss in trading futures and options. It is not suitable for everybody. We're trying to beat the markets, and that's not easy. In today's class, we're going to answer the question, are all options created equal? And the answer to that is no. I already kind of hinted the answer on that. Options are not created equal. A simple Google or Amazon search reveals a nearly unlimited number of option trading resources. There are hundreds of books on options. There are dozens of websites talking about options. But unfortunately, the vast majority of them cater to stock option traders. And a lot of people assume that if they're reading a book on options, they can just simply apply that theory to commodities, but it's really not that simple. It's true that the mechanics of a call and a put are going to be the same regardless of what the underlying is, whether it's commodities or stocks or Forex or whatever it is. A call is a call and a put is a put. That is true. But that's really where the similarities die. Everything else is going to be a little bit different. So all options have strike prices, expiration dates. They're all derivatives of some sort of underlying asset. And regardless of the venue that you're trading, they're all going to have an identical payoff diagram. As we all know, it's a zero-sum game. So if you're an option buyer and you're making money, that means the seller of that option is losing the same amount of money. Or if you're a seller of an option and you're losing money, the person that bought that option from you is making the same amount that you're losing. It's a zero-sum game. For every winner, there's a loser. And the profits and losses are equal on both sides of the transaction. Yet, there are 2 crucial differences between stock options and commodity options, and they are the nature of the underlying asset and the logistics of market execution. And these might seem trivial and meaningless, but tell you what, they can make a big difference. So you really want to make sure you're aware. A lot of traders make the mistake of making assumptions and jumping into a marketplace or a strategy that they truly don't understand the risks and rewards for. So that's what we're really big on, is trying to give people as much information as possible, and hopefully they can make the most educated decision possible as to, first of all, whether or not they should trade options, but second, how they should trade them, and third, and in what quantity and size and those sorts of things. So the biggest difference between the underlying assets is leverage. And this is big because options inherently provide leverage higher, but options on futures are derivatives of an already leveraged vehicle. So it's like leverage on leverage. This is unlike stock options. When you're trading a stock option, the option's leveraged, but the stock itself that the option is written on is not. But in commodity options, there's leverage in the futures market, and then the option is written against the futures market, and that also is leveraged. So it's really supercharges profits and losses. So all else being equal, if there's an explosion in volatility, it's going to provide greater risk and reward for a commodity option trader relative to a stock trader. So as we all know, leverage can be a double-edged sword. If you're on the right side of the trade, it's great. If you're on the wrong side, it's not so great. But the key is understanding that and trading accordingly. So to kind of illustrate, a stock trader buying 100 shares of an in-the-money call option would mean the trader is holding roughly $10,000 worth of the asset, assuming the share price is $100. So let's assume that the stock price is $100 and somebody buys 100 shares of a call, basically a one-lot call option. They're exposed, or their risk exposure is roughly $10,000 worth of that stock. A commodity trader, on the other hand, an at-the-money call option trader in corn, with the futures priced at $4 per bushel, would be similar to holding $20,000 worth of corn. So we're talking twice as much of the asset. Okay, I apologize for that pause. I actually, somehow or another, in the summer in Las Vegas, so I'm not sure how that happened, but please bear with me. So a commodity trader with the purchases a single call option in corn might be controlling roughly $20,000 worth of corn. And this, believe it or not, that's actually on the low side when it comes to leverage. Some of the other commodity markets might mean carrying $50,000 to $150,000 worth of the commodity value. So commodities, you get a big bang for your buck, but it comes with risks. Another difference is expiration. Both stocks and futures options have expiration dates, but the underlying asset of an option on a futures contract also expires. This makes a big difference, particularly in strategy and particularly if you are selling options. The finite time span on option strategies in the commodity markets means you can't turn a poorly timed trade into an investment. In stocks, you could. If you sold a put on stock XYZ and it expired in the money and you took delivery of those shares of stock, in theory, you could just hold that stock forever, or at least for a really long time. In commodities, it doesn't work like that. If you sold a $3 corn put and it expired in the money and you ended up being exercised into corn futures from $3, the expiration of the futures contract is probably right around the corner. It depends on which month you're trading and so on and so forth, but it might be next week. So you only have a week for that position to recover for you. True, you can roll over. In futures, there's something called rolling over, which really just means if I'm holding a contract that's expiring next week, I sell it and then I buy the next contract month. But that doesn't come without transaction costs and those sorts of things. So because a commodity futures contract expires, unlike a stock, the time horizon of an option trader is going to be far, far different in the commodity market than it would be in the stock option market. Now, I'm going to give you an idea of what Contango is. It's a term you've probably heard. If you've read anything about commodities, you've probably heard about Contango. To be honest, Contango probably isn't a huge factor on commodity option trading, although it is. It's going to be more relevant to futures traders, but I just want to make sure you understand it, because a minute ago I told you if you were a commodity option trader and you were assigned a futures contract because you held an option and it expired in the money, then you might be subject to the Contango when you try to roll over your contract. Here's what Contango is. Commodities have a carrying charge. There's a typo in my slide. It should say carrying charge, not chart. But it's basically the cost of carry, and it's known as Contango. This is the cost of storing and insuring a commodity before being sold. Because of the contango, the price of a commodity for future delivery carries a higher price than one for immediate delivery. For instance, a futures contract that expires in July might be trading 10 to 15 cents lower than one that expires in September. The contango prevents traders from buying long-dated commodity options because it becomes too expensive and it results in low odds of success. Here's an example of what the contango can do to a trader, or a commodity trader, I should say. Let's take a look at crude oil. The contango between the front month of crude and a contract expiring a year from now might be about $4. Now keep in mind it fluctuates with market conditions and situations, but $4 is a relatively fair assumption with crude oil at the current price, which is in the mid-40s. An at-the-money call option in crude oil would have to see the spot price of crude appreciate $4 for that option to be at the money a year from now. And that's because, like I had mentioned, there's a contango. It would cost a crude oil producer $4 to store and insure crude oil between now and next year. And that cost of carry is priced into the market. It's already built into the market. So if somebody buys an option that expires a year from now and it's at the money today, for that option to be at the money a year from now, crude would have actually had to have gone up by $4 to account for the cost of carry. Then, we're not done yet. The premium of an at-the-money call with a year to expiration might be $7 or $8. So in other words, if you bought an at-the-money call that expires a year from now in crude oil, it's probably going to cost you $7 to $8 in premium, which is $7,000 to $8,000. That's a lot of money. So as a result, the spot price of oil would have to increase by $11 just for the trade to break even. Can you imagine? With crude today at 45, you would have to see crude a year from now at 56 just to break even. You wouldn't even be making money on the trade. That's exactly why most traders really don't do long-dated options in commodities. In stocks, they do it all the time. Commodities, it just doesn't make sense. Okay, so another difference between options on futures and commodity, in stock options, is dividends. This seems obvious, but I like to point it out because some people just simply kind of overlook it, but it makes a big difference. Unlike stocks, commodities don't pay dividends. The only cash flow that occurs for commodity traders takes place when you enter or exit a trade. So in other words, if you have a $10,000 trading account and you purchase an option for $1,000, and by the way, just complete random thought here, I'm not necessarily a fan of spending a lot of money on options because most options expire worthless. So if you're buying an option for $1,000 or spending 10% of your account balance on an option, it's probably not the best way to go about it. We actually try to teach people different methods, option spreads or short options, in which you're collecting just as much premium or more than you're paying out. But that's an entirely different class. For today, we'll just keep it simple. But the only cash flow that a trader is going to experience is when they buy the option and when they sell it. So if you have a $10,000 account and you pay $1,000 for an option, your account is now worth $9,000 in cash and $1,000 worth of option value, which is considered an asset, but it is an eroding asset. So that's the cash flow. You took cash out of your account to buy the option. When you sell the option, the cash is returned to your account for whatever price you sell it for. So if you sell the option for $1,500, $1,500 is credited to your account. Now your account is worth $10,500. If you sold the option for $500, meaning you lost $500, you only get $500 in cash back, so your account is now worth $9,500. That's the only cash flow a commodity option trader will see. A stock trader, on the other hand, stock option traders don't receive dividends, but what dividends do to the stock market is they keep the market in an upward projection. Okay, so dividends keep stock prices in an upward projection, even though option traders aren't necessarily receiving dividends, they're getting the benefit of stocks tend to go higher over time. Okay, I apologize for the pause. All right, so another big difference between the two venues is the nature of the market. By nature, the stock market tends to gain in value over time due to earnings, dividends, and inflation. This is something that we just kind of have come to expect. We know that there are big corrections in equities and sometimes crashes, but eventually the market generally recovers, or at least it has ever since the beginning of time, and continues higher. Commodities aren't like that. Commodities tend to trade in ranges. And this is because dividends and earnings growth are not possible. They fluctuate. They can be in extremely volatile ranges, but they are ranges. And they fluctuate on supply and demand fundamentals as well as inflation pressures. To give you an idea, if you remember, if you follow crude oil at all, crude oil in the last, we'll just call it decade or so, has been as high as $150 a barrel. It very quickly fell to about $30 a barrel. Then we rallied back to about, I think it got up to about $110 to $115 a barrel a couple of years ago. And then we fell all the way earlier this year. We were at the mid-20s. So crude oil is trading in a range. It's a really, really big range, but it is a range. And it's volatile. So you really want to keep those things in mind when you're trading commodity options. Okay, so this is just kind of a picture or a chart showing you what I'm talking about. Despite major setbacks, the stock market has a propensity to move higher over time. This is in contrast to commodity markets, which trade sideways in the long run. Now, a lot of option traders don't really think of this as an advantage or a disadvantage necessarily, but it's a difference and something you just really have to keep in the back of your mind. As obvious as it seems, it can have an impact on your trading. Okay, so the nature of the corn market, obviously a commodity, is far, far different. You'll notice it does not go up over time. Instead, you see range-bound trade driven by supply and demand, and it can be extremely volatile, but it's certainly not one-directional. Okay, let's talk about the differences in option markets. The two primary differences between stock options and futures options is liquidity and the number of products. Nearly everyone has some sort of exposure and familiarity with stock options. You know, whether it's their 401k, their retirement account, somewhere along the line they have some money invested in the stock market, most of them. Thus, newbie option traders tend to venture into the stock options as opposed to commodity options. That's just natural. As a result, the liquidity in stock options is far better than it is in commodity options. After all, you probably don't know very many people trading commodities. Few people are trading commodities, and even fewer are trading commodity options. I mean, most people that you talk to probably aren't aware that they even exist, and if they are, they're not comfortable with their knowledge and their background. They're not comfortable with the risks, and to be honest, it's difficult to find information. I actually did write a book called Commodity Options. It only deals with commodity options. To my knowledge, it might be one of 2 or 3 out there in existence that do that. Almost all books on options cater to stock options. Another thing to keep in mind is the number of products is vastly different. A stock option trader might see thousands of stock options to trade. They have all kinds of choices on where to speculate. But a commodity option trader will probably only find about 80 to 100 commodity options listed at all. And I'm talking about markets, not individual options. But in all honesty, only about 10 to 15 of those option markets are liquid enough to trade. When you're looking at commodity options, I say stick to liquidity because it makes a big difference. You want to look at markets like the treasuries, the 30-year bond and the 10-year note, E-mini S&P, the euro. Most of the currencies, the yen is pretty liquid. Gold, I would stay away from silver. Silver futures are okay, they're liquid, but silver options are far from liquid. It's really, really tough to overcome the bid-ask spread in silver options. The grains are pretty good. Corn, wheat, soybeans are all amply liquid, but you really want to be careful. Try to stay away from option markets like lumber or copper that really don't have a lot of open interest. The bid-ask spreads are really wide, and so it makes it really difficult to make money. Okay, So for those of you in the United States, and I'm not sure what the percentage is in this particular class, I'm guessing it's probably, a lot of you are probably not U.S. citizens, but if you are, there's a definite difference between the tax treatment between stock option trading accounts and futures option trading accounts. Okay, so the big difference is in the U.S., long-term capital gains is taxed at a different rate than short-term. So in other words, if you hold a position for more than a year, you're going to get a lower tax rate than if you hold a position for less than a year. So the advantage to being a commodity option trader is instead of that rule actually applying as it's written, you are taxed at a 60-40 blend between long-term and short-term gains regardless of how long you hold the trade. So if you hold the trade for an hour, or if you hold the trade for 5 months, or if you hold the trade for over a year, it's always going to be taxed to the 60-40 blend. And like I mentioned before, most commodity traders do not hold positions for a year or more. Most commodity traders are holding their positions for a couple weeks or maybe a couple months. So it probably wouldn't get to the position where you're holding over a year, which would mean it would be an actual disadvantage to have this tax break. Stock traders, on the other hand, like I mentioned, are taxed based on how long they hold the trade. And I'd venture to say most stock option traders probably don't hold more than a year, but you know, it's hard to say. So most stock option traders are paying a relatively higher tax rate than a commodity trader would. There's also a reporting burden for stock traders. Stock option traders must list each transaction they make in a particular year and report it to the IRS. It's time-consuming, it's expensive, and it's error-prone. Commodity traders, on the other hand, receive a 1099 from their broker, providing a lump sum profit or loss. It's super easy. They receive this 1099 with a single figure, and they report it to the IRS, and they're done. So it's very easy. Okay, let's talk about differences in regulations. And again, I want to apologize for some of the pauses. I've got severe strep throat going on, and so I'm just trying to make sure I drink some water and keep things going, so I apologize. Okay, so the different regulators. If you're talking about stock options, they are regulated by the SEC, the Securities Exchange Commission. And the great thing about stock option traders is their trading accounts are FDIC insured and SBIC insured, depending on what they're holding and so on and so forth. You need to talk to your stockbroker about that. But there is some deposit insurance on their accounts. And they can move money in and out of the account with ACH money transfers. Unfortunately, for commodity traders, they cannot move money in and out of an account with an ACH transfer. Instead, they have to send either a personal check or a bank wire. So it is actually a little less convenient to put money in or to take money out of a commodity account. And commodity traders do not have FDIC insurance or SPIC insurance on anything that they hold in their account, whether they're holding positions or cash. There are other rules and regulations that are intended to protect customers. For example, commodity accounts are required to be segregated from the brokerage funds. So in other words, when you send $10,000 to your broker, he keeps it in an account that will not be mingled with a broker. I'm not talking about an individual person, by the way. I'm talking about your SCM, the brokerage firm. They'll keep it in an individual account separate from the brokerage firm's funds. So if the brokerage firm went bankrupt, in theory, your account should be safely as it is, and they'll just assign you a new brokerage firm. It doesn't always work like that, but that's how it's supposed to work. And to be frank, it did work like that for years and years and years, and even almost a century, until one time it didn't. But the regulators and the rules have kind of caught up with the industry, and I feel comfortable. Our clients' brokerage money is relatively safe. Okay, there are big differences in brokers. Not all brokers are created the same. There are stockbrokers, and there are commodity brokers, and then there's brokers that try to do both. And to be honest, those that try to be end-all be-all and try to do a little bit of everything probably aren't good at anything. And that's just my opinion. Those types of brokers, the ones that offer futures and stocks, they're known as broker-dealers. Broker-dealers tend to, I explain it like this. Broker-dealers are a stock brokerage firm that offer commodity trading on the side, but it's really not what they do. It's kind of like going into a Chinese restaurant and ordering a hamburger. It's probably going to look like a hamburger, and it might, satisfy your hunger, but it's probably not going to be exactly what you were looking for. It's not going to be anything outstanding. Well, that's what a broker-dealer is. They offer stocks, and then they also offer futures, but they're probably not that specialized or efficient at what they do. I recommend, if you are serious about trading commodity options, do it with a brokerage firm that does that specializes in it. You'd be surprised at the difference that you will find in the service levels. And I'm not saying, if most people are trading online nowadays, so I totally understand how you feel like you don't really need a broker, you don't need help, but it's all the behind-the-scenes things that make a big difference. For example, broker-dealers generally charge higher margins, so you're more apt to trigger a margin call with the same positions on at a broker-dealer as you would a true commodity brokerage. A lot of broker-dealers will restrict which products you can trade. They'll tell you which trading months you can trade, and they'll really kind of tell you how to trade. If you're selling naked options, you might get a call from them, and they may say, hey, you need to liquidate your positions, or you need to purchase options to protect yourself, to turn it into spreads, or they may not even call you at all. They might just take action and liquidate your positions and tell you later. But if you're with a commodity brokerage firm that knows what they're doing, is experienced, they may charge slightly more depending on the situation, but they're probably a better value. They're going to give you lower margins. They're going to give you better service. They're going to answer the phone and know how to help you when you need help. And not all broker-dealers can do that for you. Differences in margin when it comes to options can be a big deal. Most of you are aware of portfolio margining. Portfolio margining basically nets the risk of all positions in an account and charges a discounted margin accordingly. So for example, if you sell a put, we'll just say in crude oil, and then you want to sell a call, the margin will be netted. So you're not going to be charged margin on the call and the put. You're only going to be charged margin between the two, because the exchange or the portfolio margining system knows you can't lose on both sides. You can lose on one side or you can lose on the other, but you can't lose on both. So they're not going to assess risk on both sides of the trades, and that's portfolio margining. All commodity traders are granted portfolio margining, regardless of how big your account is, regardless of, well, generally regardless of who your broker is, but some brokers, although they do charge portfolio margining, will charge you extra, as we mentioned in the previous slide. But stock traders, on the other hand, they're not necessarily granted portfolio margining. They have to apply for it and earn it. Most brokers will require at least $100,000 on deposit to get portfolio margining in a stock account. And again, a commodity trader could probably get portfolio margining, with any account they open, but most minimums are probably somewhere around $2,000 to $5,000. So with a couple $1,000s, you get portfolio margining. One thing to keep in mind is stock traders are often required by their brokerage to have enough cash on deposit to cover the cost of purchasing shares in the event of an exercised option. This, in some instances, this might mean you're collecting $1,000 worth of premium, but you might have to have $100,000 in your account to cover a possible exercise. Now, commodity options are leveraged, and so the commodity itself is traded on a margin or on leverage, which means you don't have to have the full contract value to take delivery of the futures. So if you're a commodity option trader and you're exercised, you really only have to have enough money in the account to cover the margin on that commodity futures contract. So in crude oil, it might be $4,000. If you're trading the E-mini S&P, it might be somewhere around $4,500. If you're trading corn, it might be $1,500 to $2,000. So I mean, as you can see, it takes a lot less money to participate in the option markets on the commodity side of things relative to the stock side. So what's the bottom line? Well, although a call and a put have the same general function, it's foolish to assume that the differences in the underlying are irrelevant. They are extremely relevant, and before you start trade in any venue, make sure that you're completely understanding what exactly you're getting into. The purpose of this class is to help anybody that's considering transitioning from stock options to futures options to understand that even if they were trading successfully in the stock option arena and they have an idea and they feel like they know what they're doing, there are some things to understand before you get involved in commodities and to be aware of. And obviously the idea is to start small, maybe do some paper trading, or maybe do some trading on a very small scale to kind of learn the ins and outs, because they are two different types of markets, and just knowing the ins and outs of each of them can make a big difference. So if you're interested in learning more, we get into complex option strategies, covered calls, market theory, commodity market analysis, those sorts of things in my new book, Higher Probability Commodity Trading. And if you have any questions or comments or concerns, or you'd like to learn more about what we do, you can visit decarlitrading.com. If you think about something later today that I didn't cover, or you're wondering about, shoot me an email at cgarner@decarlitrading.com. I'd love to answer your questions.